Did you know that the average UK house price has soared by over 60% in the last decade? For years, it seemed like the property market was unstoppable, but now cracks are starting to appear. Could the UK be on the verge of a housing market crash? Consider this. Interest rates are rising, demand is shrinking, and millions of homeowners are stretched to their financial limits. At the same time, wages have barely budged, leaving many first-time buyers locked out of the market entirely. It's a perfect storm. But what happens when the storm breaks? Think back to 2008. The global financial crisis sent property prices into freefall, leaving families devastated and homeowners underwater on their mortgages. Experts are now warning that history could repeat itself, and this time the impact could be even worse. Imagine buying a house today, only to see its value plummet by tens of thousands of pounds in a matter of months. Picture homeowners forced to sell at a loss, landlords fleeing the market, and the ripple effects shaking the UK economy to its core. So, what's really going on? Is a housing market crash inevitable, or is there still time to avoid disaster? Stick around, because we're breaking down the 10 most alarming reasons the UK housing market could be heading toward collapse. And trust us, some of these will shock you. The stakes couldn't be higher. Are we standing at the edge of a crisis? Number 1. Unsustainable house price growth. For over a decade, the UK housing market has been on an unprecedented upward trajectory, with house prices rising by more than 60% since 2010. But this rapid growth has created a dangerous imbalance, one that many experts warn could lead to a market crash. The problem lies in the widening gap between house prices and wages. While property values have skyrocketed, income growth has been minimal, leaving many first-time buyers struggling to save for deposits, let alone afford monthly mortgage payments. Today, the average house price in the UK is over £290,000, while the median annual salary hovers around £33,000. For many, owning a home has become a pipe dream. This imbalance has pushed buyers to take on larger and riskier mortgages, with some stretching their finances to dangerous levels just to get on the property ladder. But as interest rates rise, these over-leveraged buyers could find themselves unable to keep up with payments, potentially triggering a wave of forced sales. On top of that, high prices have also discouraged new buyers, causing demand to cool. When fewer people are willing or able to buy, the market starts to stall. Sellers are then forced to lower their asking prices, which can quickly snowball into a full-blown downturn. The UK housing market is now teetering on a knife's edge, with prices that are simply unsustainable in the long term. If these trends continue, the risk of a dramatic correction, or even a crash, becomes all too real. But price inflation is only one part of the problem. Next, we'll explore how rising interest rates are adding even more pressure to an already fragile market. Number 2. Rising interest rates. Interest rates are often seen as the backbone of the housing market, and in 2025, they're becoming a major source of strain. Over the past 2 years, the Bank of England has raised rates multiple times to combat inflation, pushing them to their highest levels in over a decade. While this might seem like a necessary economic measure, it's having a devastating effect on the housing market. For homeowners, the impact is immediate and painful. Those with variable rate mortgages or fixed rates that are about to expire are seeing their monthly payments skyrocket. A mortgage that cost £1,200 per month last year could now cost over £1,600, squeezing household budgets already under pressure from rising living costs. For potential buyers, higher interest rates mean more expensive mortgages and reduced borrowing power. Lenders are tightening their criteria, offering smaller loans to reflect the increased costs of repayments. This has priced out many first-time buyers, further reducing demand in the market. The effects ripple beyond individuals. As borrowing becomes more expensive, fewer people can afford to buy, leading to a cooling of property sales. Homeowners looking to sell are being forced to lower their prices, putting downward pressure on the entire market. History offers a stark warning. Similar interest rate hikes in the early 1990s contributed to a housing market crash, with property values plummeting and repossessions soaring. With rates likely to remain high for the foreseeable future, the UK housing market is facing mounting pressure. Rising interest rates are not just a financial inconvenience. They're a ticking time bomb for homeowners and the market as a whole. Next, let's delve into how declining demand is exacerbating the fragility of the housing market. Number 3. Declining demand. The UK housing market thrives on demand, but in 2025, that demand is rapidly declining, and it's dragging the market into dangerous territory. With rising interest rates, unaffordable house prices, and economic uncertainty, fewer people are willing or able to buy property. This drop in demand is one of the key factors pushing the market closer to collapse. First-time buyers, traditionally a driving force in the housing market, are being priced out at alarming rates. The combination of sky-high property values and reduced borrowing capacity due to interest rate hikes has made home ownership unattainable for many. According to recent reports, the number of first-time buyer mortgage approvals has fallen by nearly 20% in the past year alone. But it's not just individuals stepping back. Foreign investors, who have historically propped up the market in cities like London, are also pulling out. The post-Brexit landscape, combined with rising taxes on overseas property purchases, has made the UK less attractive to international buyers. As a result, demand in high-value urban areas is plummeting. The rental market isn't offering much relief either. High rents and stricter regulations are discouraging landlords from investing in properties, further weakening demand. Meanwhile, many existing property owners are holding off on selling, fearing they won't achieve their desired prices in a cooling market. This downward trend creates a feedback loop. Fewer buyers mean lower prices, and lower prices lead to declining confidence in the market. Once confidence starts to waver, the risk of a market-wide panic increases, bringing the possibility of a crash closer to reality. Declining demand isn't just a symptom of the UK's housing troubles, it's a warning sign of deeper systemic issues. Number 4. Overleveraged homeowners. One of the most alarming signs of a potential housing market crash is the sheer number of overleveraged homeowners, people who have stretched their finances to the limit just to get on the property ladder. With house prices soaring over the past decade, many buyers have resorted to high-risk borrowing to secure their dream home. But now, this strategy is turning into a ticking time bomb. During the years of low interest rates, lenders offered generous mortgage deals, allowing buyers to borrow up to 5 or 6 times their annual income. While this made it possible for many to enter the market, it left them financially vulnerable. Even a small increase in interest rates or unexpected financial setbacks, like job loss or illness, can push these homeowners into default. As interest rates rise, monthly mortgage repayments have become significantly more expensive, leaving over-leveraged households struggling to make ends meet. For those on variable rate mortgages, the jump in payments has been especially severe. Fixed-rate deals expiring in 2025 are also expected to leave thousands of families exposed to higher rates they can't afford. The danger doesn't stop at individual homeowners. If defaults increase, repossessed homes flood the market, driving prices down further. This creates a vicious cycle, where falling property values leave homeowners owing more on their mortgages than their homes are worth. A situation known as negative equity. The ripple effects could be catastrophic. Over-leveraged homeowners are often forced to sell quickly, contributing to oversupply and accelerating price drops. This scenario played out during the 2008 financial crisis, and experts warn it could happen again. Over-leveraged borrowing has left the UK housing market on shaky ground. Number 5. Falling rental yields. For years, the UK's buy-to-let market was a haven for investors seeking steady returns. But in 2025, falling rental yields are shaking this once reliable sector, causing landlords to reconsider their investments and pushing the housing market closer to a tipping point. Rental yields, the percentage of rental income relative to a property's value, have been steadily declining. Why? First, property prices have outpaced rent growth in many areas, particularly in major cities like London and Manchester. While house prices have surged, rental income has stagnated, leaving landlords with slimmer profits. Second, new government regulations have added to the financial strain. Recent changes, including the removal of mortgage interest tax relief and stricter energy efficiency requirements, have significantly increased costs for landlords. At the same time, new rent control measures, in some areas, have limited their ability to raise rents, further squeezing their returns. For small-scale landlords, these factors have created a perfect storm. Many are opting to sell their properties, adding to housing supply at a time when buyer demand is already declining. This oversupply can put downward pressure on property values, accelerating a potential market crash. Large institutional investors, too, are re-evaluating their UK portfolios. With other markets offering higher yields and fewer regulatory hurdles, many are redirecting their funds elsewhere, reducing overall investment in the UK housing sector. The fallout doesn't stop there. As landlords exit the market, the supply of rental properties shrinks, driving up rents for tenants and increasing financial pressures on those who can't afford to buy. This further reduces demand for homes, creating a vicious cycle of falling prices and declining confidence in the market. With rental yields shrinking, one of the housing market's key pillars is crumbling. Number 6. Stalled construction and oversupply. The UK housing market faces a paradox of too much and too little. Construction has stalled in some areas, while others are grappling with oversupply. Together, these mismatched dynamics are worsening the instability and bringing the market closer to a crash. In recent years, developers rushed to build in urban centres, focusing heavily on high-end apartments. However, many of these luxury developments now sit empty, as demand for expensive city centre properties has dwindled. The pandemic's shift toward remote work caused many buyers and renters to seek more space in suburban or rural areas, leaving cities like London and Manchester with a glut of unsold or unrented properties. This oversupply has forced some developers to slash prices, creating downward pressure on property values. It's a stark contrast to suburban and rural areas, where there's still a critical lack of affordable housing, particularly for first-time buyers. Developers have been slow to pivot, focusing instead on profit-driven projects that aren't meeting the needs of the market. Adding to the problem is the stalling of new construction due to rising costs and economic uncertainty. The price of building materials has skyrocketed over the past few years, driven by inflation and global supply chain issues. Many smaller construction firms have been forced to halt projects entirely, while larger developers are delaying new builds to avoid flooding a fragile market. This combination of oversupply in some areas and a lack of affordable homes in others highlights a severe imbalance. It erodes confidence in the housing market and creates the conditions for a sharp correction. As properties sit unsold and construction slows, the housing market's structural weaknesses become clearer. Number 7. Economic instability. Economic instability is casting a long shadow over the UK housing market, making a crash increasingly likely. With inflation surging, wages stagnating, and global recession fears mounting, the financial foundation that supports the market is starting to crumble. The cost of living crisis is one of the biggest contributors to this instability. Households are facing higher expenses for essentials like energy, groceries, and transportation. This leaves less disposable income to save for deposits or cover rising mortgage payments. For many, the dream of owning a home is becoming less realistic by the day. At the same time, the wider economy is showing signs of weakness. Brexit-related trade disruptions, declining productivity, and reduced foreign investment have left the UK more vulnerable to economic shocks. These factors contribute to slower economic growth, which in turn affects employment and consumer confidence, two critical drivers of the housing market. Rising inflation has also pushed the Bank of England to hike interest rates, increasing borrowing costs for homeowners and developers alike. With fewer buyers able to secure affordable mortgages, demand is shrinking, and sellers are being forced to lower prices. Global factors add yet another layer of complexity. Economic uncertainty in key markets, such as the US and China, has ripple effects on the UK. Investors are becoming more cautious, pulling back from real estate markets that show signs of instability. This combination of domestic and global economic challenges creates a climate of fear and uncertainty, which is toxic for the housing market. As confidence erodes, fewer people are willing to buy, and those who already own face growing financial pressure. Economic instability doesn't just threaten individuals, it jeopardizes the entire system. Number 8. Reduced access to mortgages. Access to affordable mortgages has always been a cornerstone of the UK housing market, but in 2025, securing a loan has become significantly more difficult. This shift is leaving countless buyers out of the market and adding more strain to an already fragile system. One major factor is the rise in interest rates, which has driven up the cost of borrowing. Lenders are responding by tightening their criteria, offering smaller loans relative to buyers' incomes. This means fewer people can afford to purchase a home, particularly first-time buyers who don't have existing equity to offset rising costs. For those who do qualify for a mortgage, the numbers are daunting. Monthly repayments have surged, making it harder for buyers to budget for the future. For example, a typical buyer who could comfortably afford a £250,000 mortgage a few years ago now struggles to qualify for the same amount due to increased interest rates. Lenders are also becoming more cautious about the stability of the market itself. Concerns about falling property values mean they're less willing to take on what they see as risky loans. In some cases, lenders are requiring larger deposits, further locking out potential buyers who are already stretched thin by the rising cost of living. The reduced availability of mortgages doesn't just affect individuals, it has a ripple effect across the housing market. Sellers find it harder to attract buyers, leading to longer selling times and downward pressure on prices. This creates a feedback loop, where declining property values further discourage lenders and buyers alike. The tightening of mortgage access is more than just a barrier for buyers. It's a sign of a market under stress. Let's now examine how historical patterns of boom and bust point to the likelihood of a looming housing market crash. Number 9. Historical patterns of boom and bust. The UK housing market has a long history of boom and bust cycles, and current trends are eerily similar to the conditions that preceded previous crashes. While every cycle has its unique triggers, the underlying patterns remain alarmingly consistent, and they suggest that the market may be heading for another major downturn. One of the most striking parallels is with the 2008 financial crisis. Leading up to that crash, house prices rose rapidly, fueled by easy credit and risky lending practices. When interest rates increased and credit tightened, the market collapsed, leaving homeowners in negative equity and forcing mass repossessions. Today we're seeing similar warning signs: overleveraged homeowners, rising interest rates, and a growing affordability gap between wages and house prices. Looking further back, the 1990s housing crash followed a similar trajectory. A period of rapid price growth was abruptly halted by soaring interest rates and a recession, leading to widespread defaults and a steep decline in property values. Just like now, the crash was preceded by overconfidence in the market and unsustainable price inflation. The common denominator in these cycles is market overreach, a point where prices grow detached from economic fundamentals like wages and demand. When external shocks occur, such as rising interest rates or an economic downturn, the bubble bursts. Experts warn that the current market displays all the hallmarks of a speculative bubble: excessive price growth, financial strain on buyers, and declining confidence. If history is any indication, the housing market is vulnerable to a sharp correction. While the precise timing and scale of a crash are hard to predict, the patterns are clear. The current market conditions are unsustainable, and past experience shows that when such imbalances persist, a crash is often inevitable. Finally, let's explore the broader implications of these trends and why the UK's housing market may be at a critical turning point. Number 10. Broader implications of a housing market crash. A potential housing market crash wouldn't just impact homeowners and investors, it could send shockwaves through the entire UK economy, affecting millions of lives in ways that go far beyond property values. The most immediate consequence would be the rise of negative equity, where homeowners owe more on their mortgages than their homes are worth. This financial strain could force many to sell at a loss or face repossession, displacing families and creating a surge in housing supply that would further drive down prices. The ripple effects would hit renters too. As landlords exit the market or struggle with falling property values, the supply of rental properties could shrink, pushing rents even higher. Many tenants, already grappling with the cost of living crisis, could find themselves unable to afford stable housing. A housing market crash would also have serious consequences for the construction industry. Developers, facing plummeting demand and financial losses, would likely halt new projects, leading to job losses in a sector that employs hundreds of thousands. This would exacerbate economic instability and leave the UK even further behind in addressing its ongoing housing shortage. Banks and financial institutions would also feel the impact, as rising defaults and repossessions strain their balance sheets. A widespread crash could lead to tighter credit across all sectors, making borrowing more expensive for businesses and consumers alike. The wider economy wouldn't escape unscathed either. Falling property values could erode consumer confidence and spending, pushing the UK closer to a recession. Additionally, local governments that rely on property taxes for funding would face budget shortfalls, potentially affecting public services. A housing market crash isn't just a financial event, it's a societal one. It would touch every corner of the economy, with lasting consequences for families, businesses, and communities across the UK. The UK housing market in 2025 is at a precarious crossroads. With unsustainable house prices, rising interest rates, declining demand, and a host of economic pressures, the signs of a potential crash are becoming harder to ignore. These issues are not isolated, they're deeply interconnected, creating a fragile system that could unravel with just a small push. Overleveraged homeowners, falling rental yields, and oversupply in certain areas have added to the strain, while broader economic instability and tighter mortgage access further weaken the market. History shows us that when these factors align, a crash often follows. The ripple effects would be far-reaching, affecting homeowners, renters, banks, developers, and the wider economy. This isn't just about numbers, it's about people. Families could face the loss of their homes, renters could see soaring costs, and workers in industries like construction could lose their livelihoods. A housing market crash could leave a lasting scar on the UK, amplifying inequality and deepening the economic challenges already facing the nation. Whether the market can stabilise or is heading for an inevitable downturn, one thing is clear. The UK must address these systemic issues before it's too late. The stakes have never been higher. What do you think? Is a housing market crash unavoidable? Or can these challenges be turned around? Share your thoughts in the comments. We'd love to hear your perspective. If you found this video insightful, check out our previous video for more deep dives into critical topics. We put a lot of effort into bringing you these analyses, so please support us by subscribing to the channel. It's just one click, but it means the world to us. Thank you for watching.